Hi, this is Brett with Monarch Capital Home Loans, and today we just want to talk real quick about the way that rates are quoted. I think there's a lot of questions out there among consumers about why they get the rate they get and how lenders and banks come to those numbers. So we want to talk about that briefly. The first thing I think we need to talk about, though, is that there's a myth about the best rate. It's a little bit like trying to find Sasquatch. And the reason I say that is because we'll have a lot of people who call us and say, just give me your best rate. Give me your best rate. Well, the thing about that is that the best rate is not always the lowest rate, because the lowest rate may have a huge cost associated with it. So just because it's the lowest, it doesn't mean it's the best. In fact, a slightly higher rate at a lower cost may be the best for you, depending on how long you're going to be in the home, what your goals are, why you're doing the loan, how much cash you have to close the loan, and so forth and so on. So we always have to be cognizant of that. It's helpful in some respects to see what lenders see. And what I've done here is just pull up a real basic rate sheet, basically on a 30-year fixed, just for example. Now this is for more or less a perfect scenario where someone has perfect credit, perfect equity, and so forth, because if you don't have perfect credit and you don't have perfect equity and so forth, these numbers can change. But the thing I want you to notice, if you look at this 4.125, that's what we would call par. It's right at 100. And what that means at 100 is that Wall Street, who's more or less funding these loans, doesn't ask for any money for the rate, but they also don't pay any money for the rate. So there's no compensation to the lender for quoting that rate, which means that if you get the par rate or the going market rate, it's a good rate, but then you're going to have to pay the lender their fees and any other ancillary closing costs as well, because the lenders don't have any money from Wall Street to help it out. Now, if you want to get even more aggressive and go below the current market, you see that number is below 100, and that's 99.1. In that case, what that means is you're going to pay not only your standard closing costs and lender fees, but you're going to pay discount points, in this case 0.9 points, in order to get that rate. And so you can see here that the lowest rate is a good rate, but depending on your loan amount, it can be quite expensive. What we find a lot of people really prefer to do, and the way we structure a lot of our loans, is what we call rebate pricing, which means you're not necessarily getting the lowest rate available, but Wall Street gives us money. And on this one, for example, the 4.5%, Wall Street is paying us almost 2.2 points on your loan, and we can use that to cover your costs for you, to give you a lender credit, and to get compensated ourselves so that we don't have to charge you. So oftentimes that's the best way to structure the loan. Now, why is this important? Look, knowledge is power. So as a consumer, you just want to know that you do have options. You can buy the rate down. You can do that, but it's going to be expensive. It's not cheap. And the reason why you may get a lender credit, for example, or why your fees may be so low, is because you're getting a rate that's slightly above the market. That's not necessarily bad, but it depends on your goals. And so you want to work with a mortgage consultant who can help you navigate those options and do some analysis for you so you can see what the best is for you. So we'd be happy to help you. If you have any more questions, give us a call. Take care.